prior to 2018, if you trade an asset in on a new asset, we had to use this provision which kind of rolled the basis of the old asset into the new asset. It created a lot of confusion, a lot of headache for us as preparers. So somebody got to Congress and said, let's do away with all of that, except for with real estate. We can still trade under Section 1031 of the code for like-kind exchanges, business real property for business real property. We just can't do it with personal property anymore. Big question that this new tax law has brought in is best way to do business. Should I be a C corporation? Should I be an LLC taxed as a partnership? Should I be an LLC that elects to be taxed as an S corporation, which is a pass-through entity? Because the corporate tax rate structure, remember, corporations are taxed, and dividends they pay out to the shareholders are also taxed. That's the double taxation rule. So what's my lowest overall tax rate based on what my corporation's paying and what I'm paying? It is a big unresolved question, and it's really more of a situational analysis that's going to tell you what's best for you. S corporations, I've never seen an S corporation this big with 100 shareholders. I think the most I've seen is probably 15 or 20, and that's mind-bogglingly convoluted. The nice thing is here with S corporations and family members, husband, wife, one shareholder, makes it simple. But this whole issue of corporate tax rate being 21%, will I now be better off if I'm a pass-through entity and everything's flowing through to my personal return and being taxed at potentially 37%? Will I be better off becoming a corporation and only paying 21%? Again, you really have to look at your individual circumstances, because a couple of times that we've done this analysis for our clients, typically our corporations try to keep their income down. In the old law, you paid 15% tax as a corporation on the first $50,000 of income. This new tax law, it will now be 21% on that first $50,000 of income. Okay? So if I'm able to keep my income down that low, do I really want to be a C corporation? Because my tax just went up. Or should I elect to become an S corporation and have that income flow through to my personal return and pay tax there? Because if I tax it at the corporate level and then pay out dividends later, I'm going to pay tax on that too. Granted, at 15%, but you still have the double tax effect. So until you run these simultaneous equations, there's no simple answer for anybody. The neat thing about closely held corporations is the ability to shift the growth of a business, shift the income of a business over to other family members or third parties. It doesn't matter. This is part of an estate plan, basically, where someone who may have created something, let's just say, you're Bill Gates, and you come up with Microsoft, and you have this stock that's worthless when you start out, and you think, this is going to be great. So I'm going to take my 100,000 shares, and I'm going to put these shares in all my kids' names and my nieces and nephews' names, and then boom, Microsoft is huge. Now you've taken that appreciation and sent it down the line into a lot lower tax brackets, and it's out of your estate at the same time. So it's one of the, for estate planning purposes, it's one of the greatest benefits having these closely held corporations and being able to play with the stock that way. Because of the lower tax rate for corporations in the past, corporations receiving dividends from other corporations were able to reduce those by 80%. They only get 65% reduction, despite only paying 21% in tax. So it's pretty good benefit still for the corporations. Corporations no longer have to pay alternative minimum tax. Net operating losses can no longer be carried back 2 years. They can be carried forward indefinitely. But a lot of times over the 30-some years that I've been doing this, the benefit is that clients have had is that they have one really big year and have to pay a big tax. The following year they may have an NOL and they can carry that back, get some of that prior year's tax as a refund in order to help fund recovery or future operations. We see this a lot. I've seen it in my career where the economy has dipped, like in 92, 2008. You get these businesses that are streaming along at a certain rate, and all of a sudden they have a loss, and there's no way to recover unless they get some of that tax back. Can't do that anymore. And then there's the meals and entertainment. I have a couple of handouts here. One is a letter that just describes very general circumstances with respect to the meals and entertainment, and also a comparative chart of old tax law to the new tax law. But basically what Congress is trying to do here is completely eliminate the deduction for entertainment. Strictly entertainment. So season tickets to the Redskins, I don't know, I think one, but the Nationals, the Capitals, anything like that, any kind of sporting events, golf clubs, not maybe the country clubs, things like that, that's all gone. No more deduction. Now, meals aren't out entirely. Events within a business, for the business, they're still going to be deductible. If you have, the big question here is if you have lunch or dinner with clients and you have substantial business discussions, is that now out the window, or am I going to get a 50% deduction on that? It appears that where that's going to end up is that you're going to be able to get the 50% of that as long as there's a substantial business deduction. Now, how do you prove that to the IRS? You better keep a good record of what you discussed, like having an agenda for dinner. The other thing is that in your accounting, QuickBooks or whatever you're using, you've got to separate these items out so that you have the non-deductible, the 50% deductible, 100% deductible in separate accounts in your chart of accounts, and you properly record those expenses into those accounts. Because if the IRS comes in later and you got one big meals and entertainment account, and at the end of the year you separated it out and fixed it, did whatever you did or had us do it, IRS is going to likely want to just throw it all out the window, even the deductible, and they'll have the authority to do it. So, reaching the end of my PowerPoint, and I'll take whatever questions that you have, but if anything comes up in the way of changing tax laws or any updates that you need, and oh, yeah. By the way, Congress will be voting. They're putting forth this Tax Cuts 2.0 to a vote probably either later this month or the first part of October. It will likely come out of the House committee. It will likely go to the House floor, and it will most likely be killed in the Senate. But what they're doing in these three, you notice the closeness of the bills. What they're doing is all these things that I was saying were suspended when we went through this, they're going in here and wanting to make them permanent. So, will this get passed? Probably not. I would be shocked, surprised, and amazed if they did. What I've been reading is that it seems to be more of a marketing ploy, if you will, right now. So I don't think there's going to be any more changes. I think what we've looked at as far as the tax law that we're going to have through the rest of this year is what we have. So that's what I have, and I have about 8 minutes to answer whatever questions, or at least try to answer whatever questions.
Okay, you've done my taxes for a ton of years. Using mine as a case study, next year my taxes, assuming everything's the same, would my taxes go up, down, or be the same for next year?
I'm glad you asked that question because I did forget something. Yours alone will go up, but no. If all of the information in 2018 mirrors 2017, your tax liability should go down. I would be totally confused if it didn't go down, just because of the drop in the tax rates. The likelihood of your situation being exactly the same is probably as high as 0. But yeah, I mean, year to year, exact numbers to exact numbers, your tax rate or your tax liability for the next 5 years will be less than it was in 2017. Now in 2023, all bets are off. The thing that I wanted to mention and I failed to mention, and the IRS has come out with this warning, and I've seen it in a couple of the tax planning things that I've done for clients so far this year, if you're paying estimated tax payments and you're paying those estimated tax payments, and you're an employee receiving a W-2 and have been, so you kind of got a lot going on, but if you have withholdings and you have estimated tax payments and you decided that you're going to pay your 2018 tax estimates on the basis of what we call safe harbor, which means you pay in either 100 or 110% in tax for 18 that you paid in 17. And by doing that, you would never have an underestimated tax penalty for 2018, even if you hit the lottery and owed $1 million. There's just no penalty. Problem with this is that because of the tax law change, IRS altered the withholding tables incredibly. So there's no way in this calculation that your withholding this year on exact same wages as 17 is going to be as high as it was in 17. So you're going to fall short of that safe harbor. You need to look at your personal situation to see whether or not that would apply to you.
Similar to Randy's question, Kathy gave this similar presentation to us at Rotary, but she indicated that last tax season you compared all the taxes from 2017 to what it would be in 2018, and similar to what you said with Randy, most of them were going to be lower. Is that correct?
Yes. Who are you going to believe, though, her or me? No, that's true. Again, I mean, in parallel universe, it's going to be, your tax liability is going to be lower. And the higher your tax liability was in 2017, the higher the lower amount is going to be, the more savings you're going to have. Now, I know I didn't do that good a job presenting Nick Godwin's questions.
Regarding LLCs and pass-through, I mean, are all LLCs pass-through? Or does it have to be set up?
Most. An LLC under Maryland laws, it's called limited liability company. And if there's only one owner of that LLC, then it will show up on your tax return as a Schedule C. If there are two owners, it has to be a partnership. That LLC can elect to be a corporation. It can elect to be an S corporation, in which case it is a pass-through, or it can elect to be a C corporation. I've never seen one, but it can, and be a taxable C corporation. I did have one thing that I wanted to show you guys. Some of you might remember there used to be a form called 1040 EZ. It was the easy tax return. Well, I know you can't see this real well, or at all, but this is your new postcard tax return. Okay? Again, you might see some smoke and some mirrors in this, but this is your new postcard tax return, which basically it's your demographic information and your signature on the front, and on the back it's similar to the old 1040 in that you have your wages, your interest and dividends, and then you have this line that says, and I don't have my glasses on, other income. So there's another schedule that you have to attach to this for all your other income, your Schedule C income, your rental income, your partnership income, your S corporation income. And then you still have Schedule A. which if you're itemizing, you don't qualify for the standard deduction, you're itemized, you got a lot of charitable or medical or whatever. Then there's that schedule that has to be attached. And then there's other taxes that have to be attached. And then there's other credits that has to be attached. And then there's even more taxes that have to be attached. So, oh yeah, and there's some more credits that has to be, I don't know if you, how much you remember the back of the 1040, there's different sections, different types of credits, different types of taxes. What they did was just pull it off of this form and made another schedule. To make it look, in my opinion, this is purely just me talking here, that to make this look easy, and for anyone who has any complication in the taxes, it doesn't make it any easier at all. Something else that just crossed my mind as I was doing this that I wanted to mention. I forget what it was. It might come back to me. Yes, sir.
Is there a business structure for small businesses that can be set up that would allow for the business deduction of health insurance for partners or employees, more for partners?
Nothing that doesn't already exist, basically. I mean, if you have a corporation, you have employees, and the corporation elects healthcare, it's going to be deductible. For pass-through entities, it's going to pass through separately. There's nothing that's been created to make that any easier. Basically, the health insurance, and I haven't even looked on this form to see where they handle it, but the health insurance on a pass-through, if you're an S corporation, you have a W-2, it comes on page 1 as an adjustment. It may flow through to the Schedule A now, I'm just not sure. Oh, thank you, you led me right into it. One of the planning tools now, because of the loss of so many itemized deductions and the standard deduction going up, is a little trick that they're calling bunching of expenses. So if you're someone who is charitably inclined, for example, and you give $10,000 a year away, but because of the new standard deduction, that $10,000 a year keeps you just under the level that you would be able to itemize. So you're having to take the standard deduction each year, even though you're giving away $10,000, it's not providing any benefit. I don't know of any charities that would not agree to you giving them $20,000 this year and nothing next year. So by bunching your deductions into 1 year to exceed the standard deduction level, you're going to create a benefit that you wouldn't otherwise get if those same deductions were dribbled out over time. Does that make sense? Yes?
That's what I was going to ask you about. You know, the nonprofit, they're really concerned that with the tax changes, it will not give charitable. And so are you seeing that, or is that your thought that we're going to see that drop?
In all the years that I've been doing this, most contributions to charity are done because, other than the marketing aspect that the charities go through, most contributions to charity are done because people believe in the charity. That doesn't, tax law can't change that. What it does is it changes the thinking, like what I just said. If you can bunch that, you're still going to give, you're just going to give it differently. I honestly, in 30 some years of doing this, I don't know anyone, and I don't think that I would advise anyone to make a charitable contribution just to get the tax deduction. It's like anything else. If I give $10,000 to save 3 versus paying tax of 4, it doesn't make any sense from a financial perspective to do that, because if I pay $4,000 in tax, I have 6 left. If I give away 10 and I save 3, well, actually, that makes sense.
Yeah, I'm not going to do it about giving if you want to give, but it's interesting because it's come up in every.
Well, whenever there's a tax law change like this, the nonprofit community goes ballistic, and they're very well organized, as you can see by the, it went up to 60%. So I don't think it really changes people's generosity. That the tax law itself isn't going to be the fuel that drives that one. It might shift when it's done, but I don't think it'll change the fact that it will be done. Yeah. Hey, I've been wrong before.
Is there anything that you like about the new tax law?
I'm paying less tax. I came out of the IRS and went into public practice in 1979. I've seen a lot of tax law changes. I've seen the big ones, I've seen the small ones, they make up all kinds of names, and there's one thing that I have never, ever seen in a tax law change, even when it appears in the name, and that's simplification. Randy asked me earlier whether this was an accountant's or a tax preparer's retirement bonanza. That's true with all tax law changes, because we got to learn it. You know, it makes it for a very interesting profession because we can't sit still. We have to learn new stuff all along. But why they change certain things, I mean, who knows? At one point in time, I believe the change was actually made to drive social and economic change. It's gotten so confusing now, I'm not sure what. You look at the chart that I did about taxes over time and where we are now compared to where the country has been on top tax rates. We've really never been, except for maybe a few years in that chart, been at a better point as far as the level of our tax rate structure.
At least it's job security on your part to keep running with it, because that's what we need you for.
Well, you know, it's interesting because every time changes like this have occurred, there's been a concern in the industry about, oh, they're driving us out of this. And in this tax law change, because of the standard deduction, there's that same fear comes back in that so many people will be able to do their own returns. Well, let me tell you, for all the people that are doing their own returns, eventually I see them when they come in and they say, oh, I forgot to file for the last 8 years. Or the IRS audited me and they said I couldn't deduct my house 7 times. You know, eventually, and when something like that happens, it ends up costing so much more to fix that problem. So from that standpoint of job security, I could continue doing this until I was 67. That's next year, by the way. So, no, I could continue doing this for as long as there's taxation in this country. It's not going to change. So job security, yeah. Yeah.
Thank you, Bob.
Thank you. Thank you all. I do have these handouts that Monica and Erica and Aaron, if you want to pass these out, just to give you something to go to sleep at night with.
Or nightmares.
Yes.
Thank you again, Bob. Thank you, everyone. Does anybody have anything that they need to say before we adjourn for today? Thank you all so much for attending today. I wish you all the best. Keep the Carolinas in your thoughts, and let's hope that we do okay the next few days too. Thank you all.
No, appreciate it very, very much. It's really good for